Okay, well, thanks very much. I'm just going to skip through this stuff reasonably quickly if I can manage it. We need to be clear about the position that we're currently in, and I'll say a little bit more about last Thursday's Brussels deal in a moment. We're in a joint EU-IMF lending programme, and what that means is that the government's unable to finance itself, couldn't finance itself in the markets, and we also know that the banks are unable to finance themselves in the markets. It's also the case that Greece really was rescued from a disorderly default last week, and the deal that was done involves debt relief for Greece, which means that there's been a partial default by Greece. And we need to remind ourselves that an achievement of the single currency experiment is that 3 European countries, Greece, Ireland and Portugal, are facing sovereign default, and Greece is now defaulted. There hasn't been a default in Western Europe since, I think, the London Agreement of 1952, which cleaned up the post-war defaults of Germany and several other countries. So it's 60, for 60 years, the European sovereign bond market was regarded as, I suppose, along with the US market and the Japanese market, as the safest repository for the world's savings. And we've managed to screw that up in the last few years. Irish 10-year sovereign bond yields yesterday were 12% in the secondary market. They had been 14 briefly in the panic of a couple of weeks ago. At 12%, that means that market re-entry for Ireland, which is still planned for early 2013, is just wildly unlikely under the current programme. I just want to say a few background things about the Irish economy that we lose sight of. And the first, and it's been mentioned earlier, is that we've had macroeconomic crises before. This one is more difficult now than the 1980s crisis, and a lot of people think that we got out of this in the 1980s, lost a decade maybe, but we managed to get out of it without too much difficulty, and we'll get out of this one just as easily. But I'm not sure that it's sufficiently understood that this is worse than the 1980s for a string of reasons. We've had a record of boom and bust here anyway. This chart shows the volatility in annual gross domestic product, and this one in quarterly gross domestic product. Our macro numbers, because the economy is so small and so globalized, are very volatile anyway. And that volatility has not been offset by policy, as Philip Lane and many others have pointed out repeatedly. It's been accentuated. The reason I think the crisis is worse than the 1980s, well, there's a string of reasons. One is the banks didn't go bust in the 1980s. The banks were fine. The exchequer went bust. But this time the banks have gone bust as well. And the banking rescue has enormous exchequer costs, which may be as much as 50% of GDP. Secondly, we have to restore competitiveness without devaluing. And something that I was reminded of yesterday when people were making their tributes to Gareth Fitzgerald. And the late 80s rebalancing of the Irish economy has been credited, and reasonably enough, I think, to Ray McSherry, who was finance minister then. But Ray was a lucky general in the Napoleonic sense. And one of the reasons he was lucky is that the previous government devalued the Irish pound, as it then was, in August 1986, and there was a very well-timed and well-executed devaluation. And it happened, if my memory serves, the Saturday, these things were always on Saturdays, of the August bank holiday weekend. And on the Friday, I had dinner with Gareth Fitzgerald and Patrick Honohan, who was his economic advisor at the time, and who's now the governor of Central Bank. And the two of them were very shifty, and they were kind of whispering and half seeking reassurance for whatever macro policy was at the time without levelling or whatever. Of course, the reason is they decided to devalue the currency the following morning. But the point is that that devaluation in August 1986 provided a platform for the public finance recovery that occurred subsequently. And there were other things that went right. The UK economy was reasonably strong at that time and so on. So the fiscal correction that was deferred too long through the 1980s, we should have got it over with more quickly, but we didn't. But eventually it was sorted out, partly through good policy, but also through a bit of good luck, of which we haven't had much this time round. On the point of how quickly we should try and close the fiscal gap, we've had 3 years of fiscal consolidation. The first expenditure control measures were taken, I think, in July 2008, shortly after the departure of Mr Ahern and the arrival of Brian Lenihan in finance. So it's 3 years ago this month that we started on this process. And after 3 years, the deficit is still over 10% of GDP. We really should have got it back into single figures this year, and it's a source of regret to me that we didn't, and I think we could have. In any event, whatever we've done, the sovereign credit markets don't believe the programme, and they don't believe the programme as modified last Thursday either, because our medium-term bonds are still yielding 12%. One of the things that puzzles people is that they kind of ask, we've had all these cuts and we've had all these tax increases, but the deficit hasn't gone down. How does that happen? Well, one reason, of course, is that the economy has contracted, although it has now stopped contracting, thankfully. But the other reason is that government spending tends to go up in recessions. It goes up automatically. We have a social contract. We have told people that if you lose your job, you'll get unemployment pay and you'll get rent support and all sorts of other things. And it's important that those promises by the state are delivered on. So government spending under those headings tends to go up and has gone up quite significantly, even with cuts in the rates of payment under some but not all of those programs. The second thing that happens is your debt service burden starts rocketing up. And our outstanding debt has risen, even in those short few years, and the annual outgo in the form of interest payments has gone way up over the last few years. So that's why the blue line, which is the expenditure of general government, has continued to go up even since the corrective measures commenced, and these figures end last year. The picture this year is that things have improved, but only a tiny bit. The other thing that's happened is that the purple line, which is government revenue, really should have risen by more because the rates of taxation have gone up under a number of headings, particularly direct taxes on earned income under various guises. But because activity has slowed and total employment has fallen, that purple line has been sluggish. It's always like this. Once you get into a public finance crisis, the immediate problem is to stop it from getting worse. That's move one, is to stop it from getting worse. And it's quite hard to stop it from getting worse. There are some calculations which say that if the government had done nothing each year since 2008, since the bubble burst, if the government had done nothing, some people have calculated that the deficit would be nearly 20% of GDP. Now that's a silly calculation because you wouldn't have been let do that, and the markets would have intervened and you'd be in an IMF program even earlier. But we need to understand that just to prevent things from getting worse takes a lot of fiscal effort. We've just begun to get those two curves to move a little bit closer to one another, but we're a long way away from fiscal sustainability. These are the projected debt ratios expressed as a percentage of GDP, and the other one as a percentage of GNP, which a lot of people think is more relevant because that is closer to the tax base, and it's higher, unfortunately. And you can see that these are on the assumptions that underlie the program, that were into ratios of debt to national income, however measured, that are much higher, contrary to what a lot of people say, than where we were in 1987. I don't know where this stuff is coming from. The debt to GNP ratio peaked in 1987 at 117%. I keep hearing people say that we're no worse than we were then. On the projections, that's just not true. These are the government's funding requirements. And as you all know, the exchequer deficit, which is not quite the same as the general government deficit, in the current year is going to be 18 billion. There's 12 billion in debt maturing. That means we've got to find 30 billion, 31 billion this year. Each year you've got to borrow whatever the deficit is, and you've got to refinance the debt that matures. Governments sell bonds that are 5 years or 10 years or 6 months, 20 years, and a pile of them matures each year, and you've got to re-borrow that money. And you can see what the picture is over the next several years. This, I might add, is a set of calculations that were done prior to the deal of last Thursday. So we just have to borrow not just the deficit, but also the amount of debt that's maturing. And I draw your attention in particular to the big number in 2014, which is in January 2014, the big number for maturing debt. These are the debt maturities as they were prior to the deal of July the 21st. And the grey ones are general obligations to people who've lent us money, really bond and bill market money. The blue ones are what we have to pay back to the IMF, and the red ones are what we have to pay back to the EU. And you'll see, I stress this chart was prior to the deal of last Thursday, that we've stretched out our repayments, but they're just huge up towards the end of the decade. There were enormous amounts due to be paid on our sovereign bond debt, our own debt, the grey bit, and also to outfits like the IMF and the EU. So the stretching out of maturities that was announced as part of the deal last Thursday is important and will flatten that curve out towards the later dates. So the cut in the EU lending rate and the extension of maturities were important for us. But the downside in the deal, first of all, there was debt relief only for Greece. So, you know, the deal on Thursday was the 6th summit meeting to resolve the Eurozone crisis. And I predict there will be a 7th, an 8th, a 9th, and a 10th, and so on. Because it has left a situation where Greece hasn't got enough debt relief. It's got some, but it hasn't got enough. And nobody believes that Greece will at any stage be able to re-enter the markets under the terms of the existing deal, which means there will be further partial or total default. But the same is true for Ireland and Portugal. The markets have had a few days now to react. This morning, Ireland's debt, 10-year bonds were yielding 12%. That is inconsistent with any prospect of market re-entry. More worryingly, Spanish bonds were yielding 6% this morning, and Italian bonds, after a bit of a rally, were back up to 5.60. And those numbers are above what's sustainable, I think. Opinions differ a little bit as to what the sustainable interest rates are for those countries. Some people think they might be able to sustain 6.5. There are even people who think they might be able to sustain 7. I don't agree with that, but I don't want to bore you with the details. I think at 5.60 and 6, those were the numbers before the Brussels emergency summit that provoked it. And we're back to them now after a short relief rally on Thursday and Friday. So the objectives of the deal were to avoid a disorderly Greek default and to contain contagion to Italy and Spain. I think it obviously has achieved the first. They provided liquidity to Greece to meet its immediate rollovers and so on. The amount they provided in May last year was inadequate. Lots of people said that at the time. That's now been recognised, so it's bailout number 2 for Greece, and that means there won't be a disorderly default in Greece. But I don't believe that measures were taken last Thursday which were sufficiently decisive to avoid contagion to Italy and Spain. So I think there will be further summits. Ireland's macroeconomic prospects have been discussed by several people. Basically, the sharp decline in activity seems to be over, but there's no real sign of recovery. And I detest these debates that go on about will the economy grow by 1% or 0.5% over the next 12 months. It doesn't matter. You can't even measure what happened to the economy 3 years ago to that level of precision. And if you look back through the statistics, which Irish journalists don't do, you'll note that the CSO regularly revise the GDP figures for 2 years ago by amounts of that size. So beyond saying the economy is flat, I don't think there's any sensible basis for saying a whole lot more than that. Over the period from 2012 to 2015, you have to ask what's going to happen to nominal GDP or GNP. And I think at this stage most of us would be happy enough if the economy could grow even at 1.5% or 2%, given the international situation and the debt deflation that we're suffering. And we know that the inflation rate Europe-wide, the official target is 2%, and I think that's what's going to happen. That tells you that nominal tax bases in European countries are maybe going to grow about 4% in the years ahead. That in turn means that the interest rate can't be more than that, which is why, with I suspect a lot of urging from the IMF people, the European leaders agreed to cut the rate of interest to Greece, Ireland and Portugal below 4% on Thursday last. But there remains a clear debt sustainability problem for the 3 heavily indebted countries and also for Italy and Spain because their medium-term bond yields are still too high. So just to come to the situation here in Ireland and where I think we're at, the source of the debt crisis in Ireland is really that the government went off and guaranteed 440 billion in bank liabilities, while it was itself facing an annual deficit of 20 billion. And the banks proved to be insolvent, and the result is that neither the banks nor the government can borrow in the market. In effect, the bank guarantee has exhausted the fiscal capacity of the state, which was under serious pressure anyway, both because of our own high deficit and because of the damage that has been done to the European bond market, something that Philip mentioned and which has been underestimated here. The international sovereign debt market is not an ATM machine for governments. It looked like an ATM machine for governments in the early and middle years of the last decade, and governments were able to borrow, and they weren't borrowing that much, most of them, but they were able to borrow very cheaply. That hasn't always been the case. The sovereign lenders are typically the fund managers of pension funds, life insurance companies, bond funds, central banks around the world, sovereign wealth funds and so on. These people are managing other people's money. They are very cautious investors. European sovereign bonds were always seen as low return but low risk investments. They got a big shock the last couple of years, and they are not willing to believe what they're being told anymore because they've been burned, and they've been burned badly. So that is a part of the background that we just have to deal with. I personally think that the pure budget gap, had the banks not cost us anything, might have been manageable, but that's speculation. Without the fiscal measures taken to date, the deficit would have rocketed out of control. It seems to me that bank debt is critical. The ECB still insists that there should be no burden sharing. Philip again mentioned this point of the Europeanisation of the bank resolution process. There were many design flaws in the euro system, and a lot of them were pointed out at the time, including in a very interesting Royal Commission report that was prepared in Sweden. In 1996, the Swedes decided to stay out of the euro, as did the Danes, and they're very cunning and thoughtful people in Denmark. And people were rattling on earlier about the Scandinavian models for Ireland. All three of the Scandinavian countries are not in the euro, so I don't know if Finland is not a Scandinavian country. They get very upset if you suggest that. They also had the good sense to have their banking bust before they abolished their currency. So it seems to me that the bank debt is critical, and something that we need to push further on is a sharing of responsibility for the bank bailout with the creditor countries. The design flaw in the Eurozone that has hurt us most was the absence of centralised supervision and centralised bank resolution. And the consequence is that we were left to do the supervision and we didn't, and we've been left to pay the full cost of bank resolution. I think the lesson is that a common currency area needs to have centralised bank supervision and centralised bank resolution, as does, for example, the dollar zone. So what do we do? I'm not sure that just sticking to the programme as currently envisaged will permit market re-entry. The IMF have stated publicly that they believe there should be ECB liquidity support to the Irish banks and that this must be put on a medium-term basis. I have no doubt they put this on the table last week in Brussels and they didn't succeed in that particular item. I detected the IMF's fingerprints on some bits of the deal on Thursday. Unfortunately, they don't seem to have prevailed on this one, but they've gone public on it, and they've said that they believe that there should be medium-term liquidity support to the Irish banks. They seem to have won the argument on the interest rate. For us to continue to pay bank bondholders in full, and the government has, as you know, said that there are some categories that they don't want to pay, but to continue to pay bank bondholders in full means the subordination of sovereign debt. Let me put it this way. If I owe you £1 million and I also owe David £1 million, and I don't really have two to pay both of you, you would get very cheesed off if you heard that I decided to pay David. In other words, creditors of outfits that are of dubious solvency are in competition with one another. So if you're nice to one bunch of creditors, perhaps nicer than you should be, that's bad news for the other guys. And the idea seems to have taken hold in Ireland that if you're nice to one group of creditors, this will inspire the others. And that view, that view has been peddled by people in the financial business who can only be talking their own book. I can't think of any other reason for it. So we have effectively subordinated our sovereign debt holders who've been seriously burned. So to conclude, without the bank crash, I think, and the government's assumption of responsibility for it, I think the Irish debt might have been sustainable. But the design of the Eurozone, where countries abolished their own currencies, effectively they're then borrowing in a foreign currency, that has placed them in the position of African and Latin American countries which traditionally have only been able to borrow in dollars. They cannot, of course, create the dollars to meet their obligations. And as Paul de Grauw has pointed out, the introduction of the euro and the abolition of the national currencies increased the risk of sovereign default in Europe. And we now have the prospect of several, well, we've had the reality of a Greek default and the prospect of several others. There hasn't been a sovereign default in Europe for 60 years, and it's not a coincidence. The plans, it seems to me, for avoiding the next European banking crisis are fine and dandy, but they need to be supported with decisive actions to resolve the current one. Thanks very much.